Hello, and a very warm welcome to this webinar on Decoding SM REITs, a new way to invest in real estate, brought to you by Money Control and Property Share. As the real estate market evolves, SM REITs offer a fresh and innovative way for retail investors to access investment opportunities in high quality real estate assets with the added benefits of liquidity, regulation, lower ticket sizes, and of course, professional management. In this webinar, we will delve into the details of commercial real estate investments with a focus on SM REITs and their potential to democratize the real estate investment landscape in India. Whether you are a seasoned investor or just exploring new investment opportunities in real estate, this webinar is designed to provide valuable insights into this exciting new avenue for real estate investment. Joining me today, our experts on the subject. Let me introduce them to you. Abhishek Kudania, Senior Executive Director, Wealth Client Associates. Abhishek is a veteran of Client Associates, leads the firm's Mumbai practice with over 20 years of experience in the financial services industry. He's based in India's financial capital and excels in managing the private wealth of top business leaders and corporate executives. Also joining me, Kunal Muktan, co-founder, Property Share. Property Share, as you all know, is India's first and largest tech-enabled commercial real estate platform. It is also the recipient of India's first SM REIT license. Welcome, gentlemen. Welcome to the webinar.
Thank you. Thank you for having me.
Well, before I get into the subject of today's discussion, let me just start with a broader basic question. Let me start with you, Abhishek. A lot of times we speak about importance of asset allocation in our portfolio. In portfolio management, you must be speaking to umpteen number of clients and telling them about asset allocation and the importance of diversification, etc. Do you still feel a lot of people understand the concept of diversification? How important is asset allocation for them? Do they come prepared with it, or is it an exercise in explaining everybody about it? Because there still seems to be a lack of knowledge when it comes to diversifying your portfolio.
Sure, Mukta, and hello to you and all listeners out there. Um, Asset allocation is a subject which is very close to our hearts at Client Associates, and the way we would put it across is it's about bringing science to the process of investing. A method to the madness. And before I jump into the subject, Mukta, while all of us in India, time immemorial, have been allocating assets in various ways, I would say asset allocation is bringing a little more organized framework to the entire approach. That's what asset allocation is about. It's a framework which helps you optimize returns by reducing risk in the portfolio construction process, by combining asset categories which behave differently or are differently correlated, because different assets move at different pace, at different directions, depending on how market developments happen, whether it's financial or a geopolitical development. In fact, even if we look at the performance of various assets over a recent past to maybe even a longer term cycle, we have observed that winners keep changing every year. And asset allocation ensures that our investing is more forward looking. We don't end up chasing assets which end up performing well in the recent time period, and hence end up kind of confusing the entire process, and hence have an appropriate risk reward policy in place which also matches up with the liquidity needs. At Client Associates, obviously, when we combine asset allocation with the reallocation, the rebalancing framework that we follow very diligently, it also brings a dynamism to the entire approach to the portfolio, irrespective of how undervalued, overvalued markets could be. To conclude, there are various studies which have been done domestically, globally. There is one particular study I would like to quote about. This study was done in US with almost 100 odd large pension funds. People behind this study were people like Gary, Brian, Gilbert. And when they kind of tried to do a study and understand and determine that what were the attributes of a portfolio performance, you will be surprised to hear that 91.5% attribution of a portfolio performance was asset allocation, and 8.5% in various proportions was security selection, market timing, etc., which many of us end up spending a disproportionate time and energy to.
Well, interesting to know that because a lot of times it so happens that everybody tries to keep all their eggs in one basket, and which is what everyone tells in the financial markets and your investment portfolios to not do that. Kunal, if you can chime in, do you feel enough and more people are aware of these various asset classes, then so to say, and there still needs to be a thrust on a larger financial literacy process in speaking to people on diversification of portfolio, because a lot of times you will find people either talking about one asset class and completely talking about that and being only in favor of that, and not recognizing the other one. Because a lot of times when you meet people and discuss assets, there always is that argument or that debate on which asset class is better. What do you have to say about that?
Well, to answer that question, I would say right now the only asset class that people are really talking about is equity, because it's just been performing exceedingly well in India for the last decade or more. So that's on the top of everybody's mind. Everybody wants to play the stock market and buy stocks, and we hear stories of different stocks going up and down and people making a lot of returns and so on. So equity usually plays a very disproportionate role in asset allocation during times of when the stock markets are booming. But as soon as it sort of stalls a little bit, then people get a bit jittery, and then they move to more risk averse sort of asset classes like debt or government securities and so on. But to answer your original question, I feel like it has definitely improved over the last you know decade or so. People have been more aware of various products that have come into the market, and new products have also been introduced to the market, like REITs, for example. One there 10 years ago, it only came in 2018. That's something new that's come up. And various other structured products that are today available weren't available couple of decades ago or in the early 2000s. So that way I feel like people do know about more products. They are aware of newer product classes. How much they actually end up allocating their capital in the most optimized way, like Abhishek was just saying, is something that is still questionable. That is asset allocation is something that has been debated for many years. So it's very sort of personal and depends on what age bracket you are, and what your uh, motivations are in terms of what you want to earn when you want to retire and so on. So I feel like it's improved, but it's definitely not optimal yet.
Well pointed that awareness is there. People recognize what is REIT, small and medium REIT. They also understand what are the different things that are available in the market. But the idea is how much of it is seen in their portfolios. And I think today's webinar will clear a lot of doubts that people may have around this subject. Abhishek, if I may come to you, what role do asset classes like fixed income and real estate play in a portfolio? What benefits do they bring? As Kunal rightly said, everybody's sort of concentrating only on the equity markets at the moment, and and so there has to also be a realization of how well you can place your investments safely in the market, and therefore this question.
Absolutely, Mukta. So I would say yes, as Kunal rightly pointed out, the chatter on the street is more on equity and for obvious reasons. But I think if you kind of scratch the surface and look through some data points, we'll realize that equity still is like 4.5% of the entire household assets. So we have a long way to go if we kind of trying to build about a long equity culture in the investing community in India. Before I jump into the specific query, and I was kind of running through some thoughts as Kunal was talking about asset allocation as well. You know, um, if you look at the entire global ecosystem into how the spread between financial and physical assets are, I think we have come a long way as to what we were almost a decade or two back. And I think Back in 2002, I think financial assets in India were hardly 12%, and 88% was physical assets. As we speak today, the financial assets are close to 35%, and physical assets still are like 65%. So build-up of financial assets through equity, through bond, through instruments like REITs, through alternate assets like private equity, venture capital, have a long, long way to go. In the portfolio construction, Mukta, fixed income and real estate have a very, very significant role to play, because each of these asset classes offer very significant and unique benefits, which offer portfolio stability and growth in equal measures. Talking specifically of fixed income, the one way to look at the subject is it offers stability and income. A fixed income typically are fixed income securities like bonds, fixed deposits, etc., which typically provides a steady stream of income to investors through regular interest payments. They generally tend to be less volatile than equities and hence offer stability, especially during market downturns, which we haven't seen as many in the last few years or so. Second, I think prominent aspect there is capital preservation. Fixed income instruments are obviously often considered lower risk, making them ideal for preserving capital, especially for a significant investor community which might be conservative in their investing approach, or who could be a little closer to the retirement phase with a differentiated kind of an income mechanism. And third, obviously, which in a way complements both fixed income and real estate, is the approach towards diversification, which is how do you kind of complement your assets with a differentiated set of instruments which have a negative or low correlation with equities, with stocks, so that it provides you a cushion during stock market declines, and in a healthy stock market as well takes care of complementing portfolio with a different cash flow kind of a measure. Jumping to real estate, I think the commonality remains in terms of income generation. So obviously real estate investments, whether it has been direct property ownership, which has been the conventional mode of holding real estate in India, or the newer mechanisms of REITs or SM REITs, which we are talking about today, are instruments which can generate regular rental income, which obviously aids to the overall portfolio cash flow. Second aspect is inflation hedge. So real estate obviously appreciates in value over time, and it provides a hedge against the cost of living or the inflation which all of us experience in our day-to-day lives. And the third is diversification and the risk management kind of approach. So the way we look at the subject, I think the way we have seen people kind of investing over the years, I think fixed income and real estate, which historically have been construed as interest or yield-bearing assets, carrying a different correlation to equities, and hence add a lot of complement hedge to the overall portfolio construction. We should also remember, Mukta, that many of these assets are less mark to market, or not very apparent in terms of mark to market, as we call it. Equities do have their stock prices or NAVs kind of change on a daily basis. Many of these instruments, because of the nature of the designing of the construction, how they don't have the mark to market kind of thing embedded in, which gives a lot of comfort and stability to the lot of investors, and hence complement and adds to the overall portfolio construction.
Abhishek, another question related with what we spoke about. Well, I'm looking at the numbers, and at a total market share of about $200 billion, Indian real estate is undoubtedly one of the largest industries in the world. While the industry offers an option for investors to invest in residential and commercial as well, but commercial real estate has, of course, proven its might in terms of better and stable returns. What then is the potential of CREs as fixed income debt play in an investor's portfolio, and how can investors generate wealth through investments in CRE?
Okay, so let me take a step back again, and for each asset class or sub asset classes to grow, I think it's important for those asset classes to be widely accessible in the form and the packaging which investors can understand and consume. The first step, talking about real estate or commercial real estate, the first step was a financialization of real estate. Many years back, decades back, when you had instruments like alternate investment funds, real estate funds, which try to provide a parallel source of capital to the industry. I would say what has happened through REITs or SM REITs now, in a way, is saturation of real estate, which is a path of owning real estate or rental yield assets while reducing the typical challenges which are associated with handling physical real estate, the usual challenges in terms of handling them. And I think this, in a way, increases the immense potential which some of these asset classes like commercial real estate carry in the overall ecosystem. In fact, I think there was a Jeffries report back in early maybe this year, which spoke of how almost two-thirds of Indian households still hold investments in real estate and gold, which shows the preference which Indian investors have towards some of these assets like real estate, etc. The challenge for the industry, or the approach which people like Kunal are trying to attempt to solve possibly, is how to convert that physical into digital assets, and we're trying to make it a little more efficient in clients' portfolio, I would assume so. So I think the moment you have little more regulatory oversight, regulatory comfort, some product innovation, a better packaging, quality managers, ease of purchase, which can come into a certain asset class, I think it can revolutionize the entire participation over there. And I think we have seen this very closely in the mutual fund space. And I think the potential of commercial real estate is also immense if they were to able to walk this path. As far as their potential as a fixed income debt play is concerned, I think the first aspect there is stable income generation. So obviously, the rental yield is a paramount factor which most investors look at when they come into commercial real estate. Residential real estate in India typically fetches a 2 to 3% gross yield net, possibly could hover around 1.5 to 2.5%, depending on the quality of asset, the geography, the location you are looking at. But the commercial real estate, the CRE space, particularly the grade A offices, retail properties, hospitality, etc., could offer rental yields ranging from maybe a ballpark 7 to 9% annually, etc. Investors coming to this space obviously then are able to fetch a regular income stream, which comes along with this assets. Second is the aspect of an embedded element of the rental appreciation, because most of these commercial real estate properties and which people kind of hold in try to get into long-term lease arrangements, typically of 3 to 9 years, which obviously then provide a very stable and predictable income to many of the property managers out there, which obviously then ends up enhancing the portfolio returns. The third aspect is around capital appreciation. And as demand for commercial space increases, I think especially in key business hubs, the value of commercial properties, and I'm trying to simplify the subject, tends to appreciate over time. And this capital appreciation obviously then aids into the overall return which a particular asset can generate. And I think real estate cycles, because of real estate instrument, also because of the lesser mark-to-market feature that they carry, tends to be a little less volatile as compared to equity assets, and hence provides a hedge against inflation and economic downturns, if I may say. And obviously, it adds into the diversification benefit, as I had alluded earlier. I think broadly, I would say this is how CRE could possibly aid in terms of a fixed income or a debt play in the overall portfolio.
Right. Right. You also spoke about better packaging. You also spoke about better awareness about the product and how the product has to be brought into the market. Well, the introduction of real estate investment trust, which is REITs, well, we call REITs regulations in 2014, and the subsequent listing of the first REIT in India in 2019, unlocked a new avenue for retail investors, so to say, to benefit from institutional real estate investing. And SEBI also has upped the ante with their new framework for small and medium enterprise REITs, which will further democratize access to real estate investing in India. Kunal, if I may get you in, could you help our audience in understanding SM REITs and how they differ from existing REITs?
Sure. Yeah. So the SM REITs are a fairly new regulation. They were just notified in March of this year by the Securities and Exchange Board of India. And the background to the SM REITs is actually the fractional ownership platforms, which was pioneered by Property Share back in 2015 when we launched Property Share as a means to directly offer means to buy rent yielding grade A commercial real estate to a slightly sophisticated retail investor. And this was fairly successful. This came on the back of my own experience of having worked in a very institutional real estate fund, which was Blackstone, back in 2007. When Blackstone entered India, I was part of the three-member team that started Blackstone's real estate fund in India. And we started doing what Blackstone knew best, which was buying rent yielding commercial real estate. And the first, the REIT, which is the Embassy Office Parks, all of those assets were bought by me and the team back in the days. But then there kind of arose a problem as to how to liquidate some of these assets, because India didn't have any REIT regulations. And like Abhishek pointed out earlier, unless you securitize real estate, it's very difficult to make it accessible to the normal household. Now, he mentioned 75% investing in gold and real estate is absolutely true. That's what we all do. We buy real estate first whenever we get a big bonus or any other payout. And therefore, unknowingly, we allocate quite a bit of capital to this sector. However, the only way to do that was to buy residential real estate because it came in ticket sizes which were palatable, which we could invest in. Commercial real estate is worth hundreds of crores and very difficult to buy on your own, and therefore had always been the preserve of family offices and high net worth individuals who used to own the asset themselves and manage them. And There was a very good logic behind it because these assets, like Abhishek pointed out, give 8 to 9% rental returns. They are indexed to inflation. The rents go up by 5% every year or 15% every 3 years. At the same time, you get underlying capital growth on the property, which ends up making about 13-14% unleveraged returns, including the yield and capital appreciation. So it was a very strong product. People liked the monthly cash flows, the whole inflation hedge, and so on. But there was no way to access this product for the common retail investor. Only institutions like Blackstone were able to buy it in bulk through their funds. And therefore, when we started Property Share, we said, why don't we start a platform that allows people to directly invest in this real estate at much lower ticket sizes? We started with 25 lakhs. And now we manage close to 1,500 crores of these assets. And the industry then grew. And SEBI said, look, this is a good asset class, but we would like to regulate it because we'd like to ensure that the investment manager is well capitalized, that the reporting standards are high, compliances are good. There's a 6-member sort of independent board that has now been kind of put in. All the stuff that they did even with REITs. And that's how they came up with SM REITs in a very, very consultative process where they had to sort of manage the needs of the platforms as well as investor safety. And that's how they came up with the SM REIT regulations. Now, what SM REIT does is, the main board REITs are those REITs where the minimum asset size is 500 crores and above. So we've got 4 of them currently listed, 3 office, 1 retail. There's also warehouse REIT and a couple of infrastructure REITs. But the minimum asset size has to be 500 crores. But there is a huge amount of assets which are in the 50 to 500 crore range in the country. And these have not really been monetized or securitized over the last 20, 30, 40 years. And we build a lot of commercial real estate every year. 40, 45 million square feet gets leased, 50, 60 million square feet gets built out every year. And unless we find a way to securitize these assets, it is very difficult to provide liquidity to the owners of these assets and at the same time provide an access to the normal retail investor to own pieces of this asset class. That's how SEBI has now come up with this 50 to 500 crore bracket, which will be an SM REIT. It is a subclass within the REIT regulations. It will be governed very similar to real estate investment trusts. And in terms of differences, the size is the biggest difference. 500 crores is the minimum for REITs. 50 to 500 is the minimum for SM REITs. There are a few other differences. For example, SM REITs cannot invest in under construction and land, whereas REITs can invest a percentage of their portfolio in under construction and land. This is also an advantage for the SM REIT because it can then distribute all of the income from the assets to unit holders, whereas in the case of a REIT, only 70% odd, which is the least portion, gets distributed, and therefore the yields are slightly higher for SM REITs versus REITs, but both are sort of excellent products. Both are similar in terms of securitization of real estate. And Other than that, the other difference with SM REITs is while REITs have a basket of sometimes 7, 8 properties, and SM REIT has a much smaller basket, sometimes even 1 or 2 or 3 properties. So it's a very focused single asset investment approach, and that does lead to higher sort of returns. Similar to equity markets, when you kind of reduce your portfolio size to slightly lower, but you're really good at it and you pick the right stocks, then you could really end up making very good returns for investors. So that's the key differences between the REITs and SM REITs, and that's what the new SM REIT regulation and the new SM REIT asset class is all about.
Very interesting. If you could elaborate a little more on what are the key aspects of the SM REITs regulation now. SEBI's proactive approach in regulating SM REITs underscores actually the regulator's commitment to fostering a conducive environment, for deepening alternative investment space in India, and also looking at real estate as one of the major players. How has those regulations played a role in getting the trust of the investor?
Yeah, I mean, it's a very important question and something that whenever I answer, I feel very appreciative of the securities market regulator and the work he's done with SM REITs, because it's very easy to overregulate a sector and then completely kill a sector. It has been done by in the past by various regulators around the world, but I think SEBI, like I said, has been very consultative. They released 2 consultation papers. They really interacted with the industry. They try to understand the problems and the issues, at the same time try to sort of ensure that there is investor safety in the product. And after 2 or 3 consultative papers, they came up with the final regulations. So in that way, I feel like they've done an excellent job. And in our own interactions in applying for the first SM REIT, getting that license, I saw that sort of coming through. Now, coming to the regulations itself, like I mentioned earlier, it's very similar to the REITs. Uh, like a REIT, the SM REIT has to have a six-member board with 3 independent directors. What is different from a REIT is that a REIT investment manager needs to invest 5% of their own capital into every asset that they invest in, sort of to make sure that there's skin in the game, there's alignment of interest with investors. And there, I think SEBI has borrowed a little bit from the AIF regulations, which is sort of has a similar requirement on the investment manager. The second thing is there is a minimum net worth requirement now. The platforms earlier didn't have any net worth requirements. Anyone could come up and start a platform and start raising capital, but now you need to have a minimum of 20 crores of capital, of which 10 crores has to be in cash. The investment professionals have to have experience in managing, investing in real estate and in securities. So that's come in as well. There's lots of compliances. You can't just market wherever you want to. There are a lot of restrictions on how you can market, what you can market with. Uh, Compared to a REIT, which in itself is listed, in an SM REIT, the SM REIT has an investment manager, and here it's similar to mutual funds. Every property or group of properties that they form into a scheme needs to be independently listed on the stock exchange, and therefore, we could end up having multiple schemes, just like mutual funds, for every property. So there's ring fencing on every asset that an investor can invest in. And at the same time, you get liquidity because every scheme is now listed on the stock exchange. Now, while the minimum requirement is 10 lakhs right now, which is still almost 60% lower than what we had on the platform at 25 lakhs, so that's commendable that they've reduced that. But it's still 10 lakhs, but I think SEBI is looking to reduce that slowly to 5, 2, and maybe even lesser, just like they did with REITs. So these are the sort of key regulatory sort of facts about SM REIT regulations that SEBI has come up with.
Fantastic. It's all in the direction of making it super comfortable for the investor to make that right choice. Talking about choices, Abhishek, Kunal, I want to get both of you in here. Abhishek, let me start with you with the question that often comes to us. Who should be investing in SM REITs?
So I would say, Mukta, each asset class has a certain set of investors who may find it appealing for some various reasons. Investors who should be looking at investing in SM REITs predominantly would be a set of players who would either look at the asset from a income seeking standpoint, because as I referred earlier, these are yield generating assets, and these are the nature of assets which significantly which distribute a significant portion of their earnings as dividend. And Kunal, correct me, I think it was almost 95% now. That's what SM REIT proposals kind of suggest, which obviously make them very attractive option for investors who seek regular income. And while some of these features make them appealing for a larger basket of investors, I think moderate risk, or maybe especially a set of investors who are looking for steady cash flows, may find it very, very appealing. Second would be a set of people who are obviously looking for diversification. I think these are the nature of assets which provide exposure to the real estate sector without having the need to directly purchase and manage properties. So offer diversification who possibly they may already have a portfolio of physical real estate, and they are possibly thinking of how to migrate the physical into more digital form of real estate assets without losing the benefits which they usually have come associated with real estate kind of an asset class, and or complement that real estate exposure that they are the equities and fixed income exposure that they have along with the real estate kind of an exposure. Third, I think what's
Right.
happening with SM REITs, and as the regulations seem to have been drafted, I think it allows, as Kunal was also referring to, allows you exposure like mutual funds into a specific asset category or sub asset category, which means now investors can pick up their choices, make their choices into maybe a specific asset which could belong to a specific geographic area, or maybe a niche sector like maybe a healthcare, maybe a retail space, maybe office property, and they can combine and mix up some of these to construct their own SM REIT or their real estate or a REIT portfolio. Um, Set of investors who should be looking at REITs or SM REITs in particular could be set of investors who have a moderate risk tolerance, the way we possibly would look at the subject. Because there are two parts to it. One is the yield income, which will come through the asset class. And second is because these instruments will be listed on the stock exchange, there will be stock price movement, so on and so forth, right? So that will kind of akin to a moderate risk asset class kind of a investor. And obviously, each asset class requires investors to kind of take a little more liberal, a little more long-term approach to investing, because in the short term, asset classes can have very, very diverse, return behavior. So each of these numbers that we are talking about, whether in terms of yield or a potential for growth, one has to keep in mind that one has to be invested in each of these asset classes with a long-term perspective. So a long-term investor with a little moderate risk tolerance, looking for diversification and income with some element of capital growth, could be the ideal set of investors who could participate in structures like these.
Very well explained there, Abhishek. Uh, Taking that forward, then Kunal, how does this investor, choose the right SM REITs to invest for maximum returns?
I don't think he has much of a choice at the moment, but over time he or she will get a few more choices, hopefully, which will be good for the industry in general. But there are a few, things that every investor has to look at when they are firstly looking at any investment, and in particular, I would say SM REITs. The investment manager, that's the most important thing, who the investment manager is, what their background is, have they been investing for a long time, have they invested institutionally, for example, with a fund like KKR, Blackstone, one of the big, large alternative investment funds, and therefore they know and understand how big funds look at analyzing a particular cycle that real estate is going through, and he or she understands how to play those cycles and crystallize the right investment thesis for investors in order to optimize returns. That's very important. The second thing I think is how well capitalized the investment manager is. Like I said, you need to have minimum net worth requirements now, but 20 crores is just the base minimum. You should kind of ensure that the investment manager is not going to run out of business over the next few years. It's well capitalized. Probably share, of course, raised 350 crores in a Series B around 2 years ago from Westbridge. We are the most capitalized platform in the industry today. And finally, the people behind the platform, the founders, what kind of background they have. Do they come from investing backgrounds? Do they come from asset management, real estate investment background? And lastly, the real estate asset, of course, itself is something that you can evaluate. SM REITs is unlike a fund. Like Abhishek pointed out, you can choose which asset to buy in which location, which micro market, whether you want to buy in BKC or a retail mall in Noida, or an office complex in Outer Ring Road, Bangalore. If you are from that region, you understand that market better. You can choose it better. But there are some basic tenets of investing in real estate, which is location, how good the developer was, what the quality of the tenant is, how long the lock-ins are the rents below or above market. Therefore the tenant is he likely to kind of negotiate when escalations are going to come in, how long the lease is, whether they've done the fit outs, therefore they are more sticky, uh, uh, how the transportation and infrastructure links are. So these are the things. This is the alpha that sort of the right investment manager can get for investors.
Right, Kunal, if I may add just a little bit of a challenging question there, which is that, given the recent economic shifts, how do you see the performance of SM REITs evolving over the next 5 to 10 years? And what are the macroeconomic factors which are likely to influence their growth in the times to come?
Yeah, I mean, it's very exciting to be in the SM REIT space today. Like I said, it's a new sort of asset class, and it's an asset class that has been doing exceedingly well in India over the last 20, 25 years. Since 2001, real estate, especially commercial real estate, has never really had a dip. Even in the 2007-8 financial crisis or in the COVID-19 crisis, there was very little impact on commercial real estate. A lot of people wrote commercial real estate off in 2020, saying people will never get back to office, you'll never get the rents again. But that's not true, especially in a country like India, which is very back office, outsourcing driven. All our demand, 80-90% of office demand in the country is back office outsourcing demand. And the more the West gets into recession, the more the business in India, because they start outsourcing more to countries like India. And while we started off with very low level jobs like call centers, today we moved on to pretty high level research. Goldman Sachs, for example, does all of its equity research out of Bangalore. Similarly, for Morgan Stanley, Merrill Lynch, JP Morgan, they have large outsourcing centers. Their largest offices outside of the US is actually in Bangalore and Pune. So and these GCCs that they are called, global capability centers, we've only scratched the surface in terms of the number of companies and industries that can come to India to make use of our brilliant workforce, the quality of engineering, the talent, the very young workforce, which nobody else has with English speaking capabilities. So of course we have our infrastructure issues and so on, but politically we've been very, very stable. uh, the rupee against the dollar is something that really helps international investors, because pretty much they are paying the same rent that they were paying 15 years ago that they're paying today, because US dollar was 36 rupees when I started in Blackstone in 2007. Today it is 86 rupees, and rents have gone from 36 to 86 rupees. So as far as the multinationals are concerned, they're pretty much paying the same dollar per square foot rent, and all the revenues are in dollars. So in that way they find it a very cheap destination. They find it a very good destination to do some of this stuff. And therefore, I feel like the office market in general, whether it's SM REIT, REIT, or whatever play you have, is going to do exceedingly well over the next 5 to 10 years for sure.
Kunal, do you also see that with the emergence of SM REITs, the impact will be felt in the real estate market, especially with small and medium-sized developers also? Will it also create new opportunities for them?
Absolutely. It opens up an entire sort of plethora of opportunities for the smaller asset owners. Till now, we've only had the larger asset owners, like the big developers in the country, DLF, Rahejas, Embassy, and they've sort of been able to securitize their assets and then sell it through REITs to retail and institutional investors. And therefore, with that capital, they've been able to recycle that into buying more land, building other buildings, and so on. Right? Because the developer's main job is not owning rent yielding commercial properties. That only gives them 8-9%. Their main contribution, where they make the highest impact and the highest return, is in aggregating land in the right places, seeing where the industry is moving, buying land, aggregating it, converting it into commercial or retail use, and then finding a tenant. That's where they make 70-80% returns on their investment. But once it's completed and it's rent yielding, it's the private equity funds or retail investors who want more recurring income and capital appreciation, who kind of come in and buy those assets. And this avenue of monetization, recapitalization was only available to large asset owners so far. When you look at SM REITs, which now opens it up to the 50 to 500 crore asset owner, and there are lots of smaller developers who only develop, 3 office buildings, 4 office buildings. They can't really REIT all of them out. They've got 300 400 crores of very high quality assets. Then that is something that was completely untouched till now, and it's going to open up an entirely new opportunity for these investors. At the same time, there are tenants who own their own buildings. Lots of IT tenants, for example, Accenture, Cognizant, they own large portions of their real estate, and that is not something that is very optimal for them. But the use of that capital is much higher in their primary operating businesses. And now what they can do with their asset is, look, they can say, here is my office building. I'm the tenant. I'm willing to lease it to you for 9 years at market rents with a 5-year lock-in. Can you please give me liquidity? If not for 100, you could even sell 30-40% in the REIT, still keep them at 60%. And these things just lead to an unlocking of immense value in real estate in the country, which could lead to higher GDP growth, more employment. There are lots of things, benefits that are going to come out of the whole SM REIT regulations, which is also what I feel the regulator looked at.
Great. Let me just take now the focus back on the audience and investors that are keen in uh, in diversifying their portfolio with SM REITs. Abhishek, if I may get you in, we also have a few questions coming in, gentlemen, so I will be putting those up as well. One of our audience has asked, Saurabh Jain is his name, and Abhishek, the question is related with how much of allocation should I make towards SM REITs or CRE in my investment portfolio? He is asking. So the question soon that came after who should be investing in SM REITs is coming from an audience about if I go ahead, what is the kind of allocation that I'm looking at in my investor portfolio?
Sure, Mukta. So, frankly, some of these answers are not as straight-jacketed as we wish they could be. And each of them require a deeper conversation with each prospect investor, understanding the deeper balance sheet, their cash flows, their risk appetite, etc., etc. But you asked something very interesting, and where we kind of operate, we have in a way kind of seen the journey of a lot of HNIs, ultra HNIs, family offices whom we kind of closely work with. And each of these segments that we have studied over the years, we have seen them having a typical asset allocation mix, if I may say. And in a typical Indian retail investor has almost a 50% exposure to physical assets, or let's say property in particular, around 15% exposure to gold, and rest 35% is split across equity, debt, etc. Equity, by the way, is only close to 5%, if I may say so. A typical Indian HNI has almost a one-fourth of an exposure to property, which is physical real estate I'm referring to, a 5% towards gold, almost a one-third towards equity, and rest into other financial kind of assets. An Indian family office, we are talking about sizable balance sheets, has a 15%, 15% exposure to physical real estate, a 2% kind of an exposure to gold, a 50 odd percent exposure to equity, a 20% exposure to alternates, so on and so forth. So sort of, I really don't know which bracket would you kind of belong in. How have you seen kind of your journey in terms of understanding, deciphering many of these assets over a period of time? But you need to look at some of these sub asset classes from a need standpoint to say what is the portion of my portfolio which could be yield bearing. Now, if you look at them as debt or quasi debt assets, some portion of your debt portfolio can be through SM REITs kind of a investment opportunity, wherein along with conventional debt instruments, which also try to kind of generate an interest or a coupon, there is a structure which has an element of a coupon as well as a market appreciation, which could happen over a period of time. That debt exposure in an investor's bucket could range anywhere from 0 to 100%, again, depending on how the portfolios or the investor's risk profile could be. So that's how, Mukta, I would say that how one should look at exposure to assets like SM REITs. For a moderate investor, as we have observed, a debt exposure typically tends to be 30% to 40% of the portfolio, a portion of it can go towards instruments like SM REITs.
Got it. Now, Kunal, there is another question that is coming in from Ritika Singh, and that question is related with risk mitigation while talking about SM REITs. Could you tell us how our audience, how our investors can handle market fluctuations and economic downturns, and also while they are investing, what are some of the things that they need to keep in mind as to better mitigate their risk?
Right now, the good thing about the SM REIT regulations and the way they've been drafted by the regulator is that they've already mitigated a lot of the risks associated with real estate investing. Some of the biggest risks in real estate investing is development or construction risk, that the person is not going to construct on time, he's not going to finish on time, and therefore there are delays, which delays cash flows, impacts the IRR, and so on. But the SM REIT regulations require SM REITs to only invest in rent yielding uh, completed properties. So that sort of risk is completely mitigated. The second big risk in commercial real estate is leasing, where you build an office and then you have no one to sort of lease it from you, and therefore you have to wait a long period of time. There might be lower rents. You might have to sign up with someone who gives you a suboptimal rent and so on. That is also mitigated because you have to start off with a completed and rent generating assets. So these two primary risks of real estate are kind of already eliminated by the regulations. I would say that the one risk that exists, which is for both REITs and SM REITs, is releasing risk. Let's say that after 5 or 6 years or 9 years, the tenant vacates the property. Then what? Then how? Then what happens to those cash flows? And I think the way to mitigate that risk is firstly not take debt. If you don't take any debt, then you don't have any obligations to repay interest or EMI to the debt holder or the lender. And all our assets are completely unleveraged. The second way to lower the risk is to find properties in locations where the vacancy levels are really low. So if you look at supply demand, which is something that we look at very closely, look at micro markets where the supply that's coming up over the next 3-4 years, which is quite easy to see. You can actually go and walk that supply and see where the buildings are coming up. For example, Hyderabad has a big oversupply in Gachibowli, high-tech city. You might try to avoid that, but if you go to Outer Ring Road in Bangalore, Whitefield, or even BKC at the moment, there's not much supply, vacancy is low, you're most likely going to get another tenant pretty quickly. So the investment manager is quite important in choosing the right sort of properties to mitigate that risk. So I feel like that is the only sort of risk that is apparent in an SM REIT sort of structure. What we do tell our investors, we've been doing this for 8-9 years now, is don't buy one, buy 3 or 4 properties, and therefore, even if there's vacancy in one of them, you still have a bulk of your portfolio generating income in the meantime. So as far as the industry and general macro is concerned, real estate in India has been, like I said, not very strongly correlated with the rest of the world. It has very different demand drivers and demand factors. Right now is a very good time to invest in real estate because interest rates are really high. And when interest rates are high, yields are high. Once interest rates begin to go down, the capitalization rates, as they're called, or the rates at which you buy these properties go down, and you end up making very good returns on your capital.
Gentlemen, before I let you both go, one last question, and Kunal, if you can take this up, or Abhishek, given the limited track record of SM REITs, what metrics or indicators should investors prioritize when evaluating potential investments?
Right, I can take that up first. So uh, there is limited track record of SM REITs, but there is an 8-year track record of fractional ownership platforms, which led to the SM REITs. So you can definitely go there and see what's happened in terms of returns, exits, and so on. We've provided a lot of exits to investors. We've given a lot of capital back to investors over the last 6-7 years. The data is there on our website to see. So that it does exist. But the best thing about SM REITs is that when you invest, you don't really need background information, because you are buying an asset which is in front of you. You can see it, you know who the tenant is, you know what rent he's going to pay, you know how much you're going to get on your investment, you know how long the tenancy is or the lock-in is, where it is located. So in a way, you are the investment committee, unlike a fund like Blackstone, where you give the money to an investment manager, they go and find properties, and then you just sort of, they draw down capital and you invest. Whereas here, you are the investment committee. You are being presented with the same sort of analysis in front of you, and you can decide whether this is a property that you want to invest in or not.
Got it. Abhishek, one last question that has come from one of our audience members. They're asking on the tax implications for investors in SM REITs.
So I'll request Kunal to kind of take it up.
So, yeah, so the tax of SM REITs is the same as REITs. So it's exactly the same as, it's very, very good and very benign. In fact, now, because of the recent change in the the long-term capital gains tax, it's become very beneficial to own units of REITs and SM REITs. Till the budget, the SM REIT units were still treated as long-term capital gain after 3 years. Contrary to all listed products, which was 1 year. And now that has been brought in line with listed products. So now if you own units of Embassy Office Parks or Mindspace or Nexus or any of the other REITs, as well as the first SM REIT that we launched, your whole period is only 1 year. After that, it becomes long term, and you sell it at 12.5%. As far as the other cash flow is concerned, which is rent, that is taxed in a variety of ways. So the REITs, all of the REITs do it in different ways. But there's dividend, there's interest, and there's repayment of capital. Repayment of capital, there's no tax. Bulk of the distribution is done as repayment of capital, so there is no tax in most of the distributions. Some part of it is done through dividends, where there is a marginal tax rate, and then part of it is interest. Therefore, it depends on which tax bracket you are. If you are in the highest tax bracket, you pay 39% of the interest part of the distribution, but nothing on the others. And if you're in the 0%, then you pay nothing in any of those other components of your distribution.
Well, thank you to both of you for taking out time and having this wonderful and very detailed discussion on SM REITs and the investment opportunities that it provides to everybody. Thank you so much. Well, as we wrap up our discussion on SM REITs, it's clear that this innovative investment vehicle holds significant promise for transforming real estate investment in India. By offering greater accessibility, liquidity, and diversification, SM REITs are poised to open new doors for investors across the spectrum. We hope this session has provided you with valuable insights and a deeper understanding of how SM REITs can fit into your investment strategy. Thank you for joining us today.